After putting in a monthly low of 2.71% on May 26th, U.S. 10-year yields turned higher and have moved up to 2.86% on the 31st. Now, oddly, this comes after a PCE number on Friday that many analysts initially interpreted as better than expected regarding inflation. Some traders, however, may believe that the PCE number could take some of the immediate pressure off the Fed and that could ultimately lead to more inflation in the future. Now, the 5-year break-even rate showed a growing inflation concern as it has moved from a low of 2.86 on the 24th up to a current level of 3.03. Now, even Fed rhetoric has been a little confusing over the last week as Atlanta Fed President Raphael Bostic made some mildly dovish remarks early in the week, only to be walked back later in the week by Fed Governor Christopher Waller, who sounded much more hawkish. Now, if a trader believes that inflation is not under control and then long-end rates could be moving higher in response, they could express that by buying the micro-June 10-year Treasury yield futures contract at 2.90 and target a move up to the 2018 highs of 3.25. A stop for this trade could be placed below recent lows at 2.68. Now, this trade could make $350 if your target is reached and risks $220 if you're stopped out of your level. Now, if a trader believes that 10-year yields could resume the downtrend that began earlier in the month, perhaps because they believe the Fed is resolute and is willing to risk significant slowdown in order to contain inflation, they could express that by selling the micro-June 10-year Treasury yield futures contract at 2.87 and target the March highs of 2.48. A stop for this trade could be placed above at 3.15. This trade could make $390 if your target is reached and risks $280 if you're stopped out at your level.